Good afternoon, everyone. Welcome to our November Estate and Tax webinar, Business Founders and Investors, How to Use QSBS to Save Taxes. My name is Xiaowei Li. I'm a partner and estate planning attorney at RUI Attorneys. Together with me is our tax attorney and tax planning strategist, attorney Michael Li. Michael, first, could you please introduce yourself?
Greetings all. It's great to be with you for this topic. You have to forgive me, I have a little difficulty with my voice. It's that time of year. So great to see you all. And this is a little bit of a fun topic to learn about QSBS and some estate planning techniques that can be deployed with QSBS. It's for a particular kind of situation, but if you have that situation, there's a lot of benefit going through this path.
Yes, as Michael mentioned, today we're going to discuss a very popular topic for startup founders and early investors, how to use USBS to save taxes. USBS stands for Qualified Small Business Stock, if you don't know yet, and it is a tax incentive governed by Section 1202 of the Internal Revenue Code and is a key element of startup tax planning, especially after the passing of the Big and Beautiful Act, which increased the benefits and the applicability of QSBS. Before we start today's discussion, I just want to mention a disclaimer. Our webinar is for educational purpose only. If you have individual questions, you have legal questions, please reach out to us and we're happy to schedule an individual conversation with you. Okay, Michael.
Really about this topic, I'd like to underline that for this topic because QSBS is quite complicated in the details, but appears very simple. So this is one of those things that there's at first blush, when we go through this, you say, oh, wow, this is really, really simple. This is very easy to do. There's actually a lot of nuance to it. So,
this is a classic concept. The devil is in the details. You really need to work with very experienced tax planning attorneys or CPAs to get to work.
Also, you need, which is a little bit unusual for planning, which we'll see, often you'll need company side people and you'll need individual side people, and they both have to work together. We'll see that as we go forward.
Great, Michael. To start, I just want to. I know we have very experienced audience, but at the same time, we also have some audience they probably have no idea what QSBS is. So first, I think a threshold question is to save tax. To save what kind of tax using QSBS structure, and can you explain QSBS in plain English?
Yeah, so QSBS is for qualified small business stock. So this is generally stock in a young C corporation that meets certain rules, can qualify for a very, very substantial tax break when the owners, the original owners, sell the company. It's acquired by another company, and basically I'm out. This gets a little bit complicated, is that QSBS generally envisions essentially more of an outright sale. So for the outright sale, it's generally that my friends and I, we put together the company. It's a C corporation. We grow it, and another major company says we're going to buy it from you, and they buy it. This is where this gets a little bit complicated, and I don't really want to go down this road, but I just want to highlight the complications in Silicon Valley. And years ago, when I used to do a lot more work in this area, in the large firm space, this QSBS is good for the individual taxpayer, works very well, but this is generally considered a cash out buy. Basically, the owners, the four original owners of the C Corp that were kind of partners that started it up, they basically say, that's it, this is being sold to major tech company. Well, a number of the people on our call here, and friends in Silicon Valley say, well, actually, a lot of the acquisitions don't go that way. A lot of them are actually the IRS tax-free reorgs, where it will be a tax-free merger, or it will be a tax-free combination. And so it's going to go under actually different sections of code, 368, or it's going to go under 351, where I'm going to exchange my stock in my original company, and I'm going to get stock in the new company, and it's going to vest over certain terms. In that situation, sometimes QSBS won't work. So there are the complexity of this. It's going to depend on the kind of transaction that you're facing, and this can be good to know, or very good to be aware of, is as the negotiation for, let's say, the sale of the company starts. If you know a little bit about QSBS, you are in a better situation to essentially negotiate your deal of saying, well, how about I get stock investing on these rates, but I want X amount of cash. Tax people, we call this boot. I want X amount of boot that basically fits in QSBS. I'll get that tax free. I'll get that right away, and then I'll get the vesting in stock, and I can kind of play both strategies. So this can be informative for that. So what is basically QSBS? First thing is we have a C corporation, and you obtain the shares at original issuance, generally not resale. And there are some situations where it can be resale, but generally it's from an initial issuance. And the company was small at the time, less than $50 million in assets. And the company's work is in active business. So it's actually employees doing active business. So a number of kinds of businesses don't work for this. So for example, like investing, if I create, a few of my friends would get together and we we create some sort of investing business, that's not going to work. So the key things to be aware of with QSBS, one of the key things is C Corp. It's not going to work for an S Corp. So many small businesses, many people operate operate their business under the S Corp situation for the pass-through taxation. And of course, that's very attractive. But if you have the S Corp, you will not qualify for qualified small business status. It generally needs to be a C Corp. So that's something to consider for the size and scope of a business. Should we choose S or C? Well, if we're really growing and we're going to plan to sell, maybe C would be better. So something to take a look at. The capitalization amounts, $50 million or less, that's usually okay. Company's business is active business, that's usually okay. That often makes sense because of C Corp, because you can't do it, let's say, for a real estate business, but that also makes sense because I probably don't want a real estate business in a C Corp anyway because of the double taxation. In addition to this, we have the rule that this is a timing rule. The shares have to be held more than 5 years to get the full benefit. If the shares are held for less than that, I may get a partial benefit or no benefit. So with this, the key things are C corporation, original issue, small company, less than $50 million, does active business, and I hold this for 5 years. So this is the prime example in Silicon Valley. My friends and I, we're well informed, and we know certain technologies, or we know certain things. We form a company. We quit our jobs, we form a company. We have multiple of us. Our company actually is to make something, software, hardware, something like that. We're actually making something. Our initial capitalization of the company is relatively small. Certainly less than $50 million. We actually work for the company. We make something. We're building this. We're building it for about 5 years, and we have a product that's quite attractive. This thing's quite good, and the company is working well. Maybe we don't have significant revenue, but this is this thing is well structured and well designed, quite good. We start to get the attention of acquirers, other companies, and they say, yeah, we want to buy your company. That what you're doing, we want to absorb that, and the whole Silicon Valley, but throughout the country, we will reward you handsomely with money. That's what this is for. Because if the company says, we're going to acquire your company, we want you four guys and gals, you to sell the company stock to us, and we will give you cash, then what happens to me as the seller, as the founder, Well, I've held it for more than 5 years. It's a capital gain. It's long-term capital gain, but I have long-term capital gains tax. I have income tax on the sale of my shares on my company. So if I say, okay, large tech company, I'm going to sell my 25%, and they say, great, we'll buy you out. Each person, because the company now at this time is worth 60 million, you're each going to get $15 million. I say, fantastic, yeah, I got $15 million. But then I have to start to realize that, wait, $15 million in year one, federal long-term capital gains tax 23.8 plus California, I'm going to be in the 13% bracket. Wow, that's a lot of income tax right there as long-term capital gains. So the problem is the long-term capital gains tax on that sale of that. If I sell out of the company, I say that's going to go to a big tech company, and then I'm going to have cash, and then they're going to have the stock. This is what it's for. That's the transaction that they envisioned, that I'd be basically selling the company. Again, this was really drafted when they were thinking about a little bit of a different style of company, where basically I'm just selling the company outright and I'm walking away. In Silicon Valley, that tends to be much rarer. You tend to not have the sale and walk away. Why? Because they generally want those 4 people to stay on, because you got to keep developing that thing. This thing needs to keep going. So because of that, in Silicon Valley, companies often will do the tax-free reorganization where they can acquire, and they say, well, how about you give me your stock and I give you give me yours and I'll give you mine. And so you give me A Corp stock, and then you give all of A Corp stock, and then we'll give you B Corp stock, and then you now have B Corp stock, and we'll do it over time. You'll get a third, a third, a third. Well, that is tax-free to the parties if it's in the tax-free reorg. But savvy negotiating says, well, yeah, but I don't necessarily want just B stock, because then I've got this same problem. If I get B stock, I'm going to have a problem with the built-in capital gains, because if I then sell the B stock, I'm going to get the long-term capital gains. Well, what do you negotiate as part of the deal term sheet is to say, well, I want boot. I want $10 million. I want $5 million, whatever it is. And then I want the other part in the stock. So let's split it. And they say, well, the boot's taxable to you. And I say, yeah. I know the boot's taxable to me, but it's QSBS. So actually that part I'm going to shield under the QSBS. And they say, oh yeah, I see what you're doing. Okay, we're going to do the tax-free reorg with boot. Okay, that'll work. So you can see this, knowing a little bit about it can help. So this is the initials. What is QSBS? Let's take a look at the next slide. What is the QSBS? Why do we care about this? Well, why do we care about this? This is very, very rare in the tax code. I'd say this is exceedingly, exceedingly rare in the tax code, particularly like with real estate. Everybody who knows about 1031 exchange or things like that, well, that's just tax deferral. We talk a lot about charitable remainder trust. That's tax deferral. This is basically tax-free. And what this is, if the rules are met, you have the C corporation, the 5-year holding, the low capitalization, the company actually, it does active business, it actually does work. If the rules are met, QSBS, this section of the Internal Revenue Code says 100% of the gain on the sale can be tax-free for federal income taxes, the long-term capital gain. Presently, under the code, the amount is capped per person, per company, at the larger of $10 million or 10 times what you paid for the stock if you had to buy into the company. Oftentimes, if it's original issue, there was no buy-in for me. I didn't pay for the stock. There wasn't, unless it's like a VC transaction where there was capitalization. Oftentimes, I wasn't capitalizing the company. I was just one of the owners. But right now, it's $10 million. Next year, it's going to be $15 million. So what does this mean if I have my set of shares and it's a QSBS company? I built it, I grew it, I held it for the 5 years as a C corporation, we're doing all that. And then big tech company or some other company says, yeah, we're going to buy that. We're going to buy you out, Mike, and you're, go off into the sunset. I say, yeah, I'm happy to go off into the sunset with $10 million. Yeah, that sounds good. And then QSBS says, and Mike, you can go off into the sunset and the IRS is not going to ask you anything. They're going to say, yeah, that $10 million, it was $10 million or less. You file it, you report it on your tax return, you do all of that correctly to claim it as QSBS, tax-free. You get that not subject to capital gains tax. Why? And this is the beauty of the American economy, I'd say, a proud Californian and American. Why do we have QSBS in the tax code? Because we are an entrepreneurial capitalist country. We say, yeah, if people basically quit their jobs, took a whole bunch of risk to open a company with their friends, spent 5 years, blood, sweat, tears, and money, churning this thing, trying to build something, and they build it, and they build it, and then all of a sudden, yeah, it worked. I built it. It's now, my shares worth $10 million. Fantastic. And then all of a sudden, I'm hit by federal income taxes. What incentivizes me to do that? Like, that all of a sudden looks like, yeah, that's a great situation. If it worked, sure, I got the $10 million and you take out, a third of it. I've still got $6 million. Yeah, I'm happy. But that's assuming I succeeded. There's a lot of risk to that. What if it failed? What if I do it a couple of years? I do it 5 years, 6 years, and all of a sudden that thing's not the technology that's the winning one, or it just didn't work, or something happened, it just went awry. Well, what the tax code is trying to do with this is incentivize people to be entrepreneurial, to build things. We want people to build things. We want people to create. And as you notice, this wasn't regarding things like investments, real estate. This is creating a company that is actively doing business, creating things, employing people, and growing. And we say, yeah, if you do that, we're going to give you a break. And the federal tax code has qualified small business stock, and you can get your $10 million and you can report it. You'll put, $10 million on your tax return, and then you'll mark, that it was QSBS on the appropriate schedules. And the IRS says, yep, looks good. Good luck, sir. In fact, I hope you do it again. We want you to do it again because it's per company. If you want to do it again, do it again. You can do it over and over because we want that. We want to create these things. We want to create them here. Otherwise, if I say every time I start a company, I get taxed to death, what am I going to do? I'm going to start creating companies in other countries and say, let's go, we're going to open our company. We're all going to Singapore, and we're going to do it because Singapore is not going to stick it to me. So we're not going to do it here. Well, we want it to be done here. We want you to do it here. So because of that, there's a tax benefit. There are some situations called rollover that if the sale is happening earlier than the 5 years, I can and sometimes roll over by doing the sale here and then buying other QSBS stock. There can be rollover in that situation. It's complicated. I have not really seen it so frequently because it's sometimes difficult to sell one company and then buy into the other. It is challenging, but it's there is a procedure if it happens. Again, this also has to be a US C Corp. So people say, oh, I'm doing something, I have that Singapore company. Can I do it there? No, it has to be a US C Corp. So why we care about this is a massive, massive tax freebie. We're talking, you're $2.3 million here, tax free. You don't get that too much. So that is important. So let's take a look at our next slide.
Michael, I have an additional question as to the industry. So usually from your experience, what kind of business, what industry used QSBS structure a lot? Like, you mentioned the high tech. How about other industries, like some traditional industry, like a manufacturer?
This was originally designed for manufacturing. This was originally designed for me for the traditional industries, for that I would be creating, let's say, a construction company, and I and my sons, create the construction company. We grow it, we become, the best in this particular kind of construction, and then we reach a certain age and we say, you know what? I put in my time, I put in my 5 years, my 7 years, my 10 years into this. I grew this thing, but I can't keep doing construction anymore. I'm out, and I'm going to sell it into the, other big, local construction company, over to someone like that. So it's generally was thought of for these traditional industries. Where I see it the most, we, tax practitioners, we poll other, practitioners. Is a lot of the QSBS happening? It's happening in Silicon Valley, because this idea of, could we create a company of, 3, 5, 7, 12 guys and gals and grow the thing into a $50 million company? That's kind of a Silicon Valley thing where we do that, where we could all sit in somebody's garage and we could create something, that's massively valuable, massively socially important, solves a lot of problems, and it's not terribly capital intensive. Again, if I say I'm going to manufacture things in the U.S., that's going to be a fairly massive capital outlay. So it's interesting in that it was originally designed for traditional businesses, but it has really found its home, like a lot of things, in Silicon Valley. There's a question that was posed: will an LLC qualify for QSBS? Only if it was taxed as a C corp. So it is if it was taxed as S corp or taxed as 1065 pass through, no go. It has to be a C corp. So it doesn't have to be necessarily a corporation. You could have an LLC that is organized under state law as an LLC and filed the check the box rules, the election to be taxed as a C corp, but that is not necessarily so common. There are some situations where I see LLCs where there's an election to be a C corp, but that I'd say is not necessarily so common.
And there's another question: does S corp has a similar type of QSBS for 2025? I don't quite understand this question.
No, S corp generally just doesn't qualify.
Yes.
So as S corp, because it's pass through. So S corp generally doesn't qualify. For things that were S corps or pass throughs, they don't necessarily have to be the C corp since the initial start, since the initial inception. But if you take a pass through and convert it, the 5-year clock starts upon conversion. So if I have something that's an LLC or an S corp or something like that, I would have to make a judgment call, working with my tax professionals and lawyers to say, is this worth it to convert to C corp or not? And it's really actually sometimes a difficult call that I've experienced in practice of depending on the style of company. Sometimes the company, they say, well, it's operating at such a loss and we pay so much in salary anyway, heck, convert it. It's not going to make any difference. Let's try to convert it and qualify for QSBS. But for things like other companies that don't have that situation, where you are having significant revenues and the revenues are being passed through as S corp or 1065 pass through and are avoiding the corporate tax, conversion to C corp could be very, very painful.
How about an investment company? If it's a company only does investment business, not like a industry.
More often than not, that will not qualify. So investing style businesses generally tend not to qualify. This tends to be issues that are or generally for businesses that are employing people that are doing active business. This is the same way for service businesses generally are not qualified. So there are exclusions. You have to be, for QSBS, you have to be in a qualified trader business, and it excludes things specifically, alas, like law, like a law firm. So if I get my friends together and we're doing really well as a law firm, we have a big book of business, I say, let's sell the firm. We're not a qualified trader business. So health, law, engineering, architecture, accounting, performing arts, consulting, financial services, brokerage services, businesses where the principal asset is reputation or skill, those things may not work. Other ones that are kind of surprising that I've encountered that I was actually quite surprised at, because I initially thought this would qualify. Restaurants don't qualify. Restaurants don't qualify. They're specifically excluded. So I was quite surprised because that one employed a lot of people. It seemed like it was a business that would be qualifying for QSBS, but it's specifically excluded. So that's one that interestingly enough doesn't qualify. So that's part of the QSBS process, or as a business is initially set up and starts to develop, is usually early, often on the company side or the founder's side, working together with the company, will often begin to reach out to lawyers and tax professionals to say, how are we, how do we look for QSBS? Does this qualify or not?
Okay, we have so many questions coming in, but I think we have to move on because for the lunch we only have 1 hour, most of the people. So let's try to move on. Keep our pace. And if you have any question, if we have time, we'll answer it after the presentation. But if not, maybe we'll consider to schedule another time to discuss this topic. Okay, Michael. The next question would be like, is QSBS is a it's generally it's a federal rule for federal tax. How about for residents in California, for California taxpayers?
California, alas, California FTB, it's a hobby is that I have is like trading collectibles of things that are kind of silly, so like typewriters and antique cameras and things. And there's anybody who trades collectibles. There's kind of an old joke that they say, when the seller the seller basically says, "I know what I've got, I know what I have." That basically is the seller is smart, and the seller is not going to let the antique camera go. If they have a sort of antique Leica camera or something like that, they say, "I know what I've got. I'm not going to sell that for $300. This is this new was a $5,000 camera. They know what I've got." That's the California reality check. California knows what it's got. California knows that it has Silicon Valley, and California knows that these startup companies and this sort of transaction is quite valuable and works particularly well. So California does not conform to the IRC on this area. So what does not conform mean? Our tax people, it doesn't match. Some parts of the California R&T code, the Revenue and Tax Code, mirrors, and we call it conforms to the IRC. So the rule that you have on the federal level is the rule that you have on the state level. California, no. California does not have QSBS. So California does not follow the rule for general QSBS, and California does not follow the rule for rollover. So what does this mean? I'm in California. I've got my tranche of my $10 million stock. I check the QSBS thing. We plan for it initially. We do what we're supposed to do. I I've got my 10 million, I'm working, I passed the 5-year threshold, I start marketing the company, there's company says, we're gonna buy it, and I say, great, okay, let's start planning. And I say, okay, great. So I'm gonna save 23.8, and it's $10 million, so I'm gonna save the 13.9 on California. Wrong, no. You're going to save the 23.8 federal, but you are going to pay the California portion. California does not give you this benefit. You do not have this tax break. So if you are a California resident, you will pay California taxes on those stock gains. So that's even if the company is incorporated in Delaware or incorporated in Nevada, Wyoming, those things, you will pay there. The reverse, if the company is in California, but you are non-resident, you won't be taxed on that because we tax residents of California. So be cautious or be aware that California does not conform. So there's a federal tax benefit, but California doesn't. We'll see in a moment. There are some things we can do about that, though.
Michael, feel free to grab a water.
Oh, yes, I have it actually right.
Yes. So, for California, we know California does not conform. But how about the other states? We know you're licensed in Washington State and Nevada, Wyoming. For these states, what are the rules?
Well, those ones are easy. Washington State, Nevada, and Wyoming, they don't tax. For Wyoming and Nevada, there's no individual income tax. Washington State, there can be certain twists in some situations for capital gains, but generally you're clear. You have to check your state. If God help you, if you live in New Jersey or New York, because in some situations, just like California, they don't conform either, and their rates are higher. So for them, you have to be careful. So for this planning, there's a federal level and then there's a state level. How does this work? There's a federal level analysis planning. That's one tier. And then you have to do tier 2, a state level analysis and planning. You'll want to do both.
Well, this is just a reminder in general for our audience. In the US, you always need to pay attention to both the federal level and the state level for both actual legal and tax planning, because a lot of laws are state specific, but a lot of laws are also federal. So you need to know both. If you're a resident in California, obviously you need to know both California and the federal rules in laws and the taxes. Let's change to the next slide. Let's talk about how to combine the estate planning goal with QSBS. How does QSBS and estate planning work together?
Well, the first thing that one wants to do is, of course, whenever you have assets of this value, make sure your fundamental estate plan is up to date and does what you want. Because again, you've got $10 million here. You potentially have $10 million that's also federally tax-free. So first thing, always get your general house in order. That's number one. Number two, remember about this, that this is a free $10 million per person. So if, let's say, I have my startup or my company, and I'm dealing with the acquisition process, I say, uh-oh, I got $20 million. I'm over. They're going to buy out my tranche, and they're going to pay $20 million. I'm over the amount. What happens? Well, QSBS, as of this year, the limit is $10 million. So after the $10 million tax-free, they say, well, that extra 10, that's the tax comes back. You used up your QSBS. There's no more QSBS credit there. Well, what can I do? I can do QSBS stacking. So you are allowed to stack QSBS. How do you stack QSBS? The rule with QSBS is that the transferee takes the same tax attributes as the transferor. using the Latin, suffixes there. What does this mean? If I held the stock for 5 years and it qualified for QSBS, and then I have my child and I say, oh, I want to gift the stock to my child, the next 10 million. Or better, just far better, I want to do it through an irrevocable trust, a non-grantor irrevocable trust. I'll create an irrevocable trust. Half the shares I'm going to keep, that's my 10 million. The other half I'm going to gift into the irrevocable trust. The irrevocable non-grantor trust is a separate tax person. 10 million free for me, 10 million free for the trust. I've now doubled the QSBS. That's called QSBS stacking. So for this, if I am doing so well, I'm running out of QSBS because my exit is going to be so valuable, it's going to be so high, I can do strategic gifting and stack. This is especially good now because we have very, very high estate tax exemptions. So if I'm a single person, now the exemptions are just about $14 million. I could completely do that transaction that without incurring any gift tax either. So I could say, actually, if I have $20 million of assets right now of the stock, I can gift the $10 million into the irrevocable trust. Yeah, I'll lower my estate tax lifetime exemption down 10 million. I'll only have 4 left. Okay, that's fine. But I got $10 million out, and I got $10 million out income tax free, and mine is going to be income tax free too. That's a really, really good transaction. That saved a lot of money. Because one of the problems is with irrevocable trust planning is when I do the gift, there's carryover basis. And when there's carryover basis, if I do gifting of appreciated assets, I kind of stick the beneficiaries with capital gains tax income. But not here. I don't stick them with that here. By creating the additional transferee, I've doubled the QSBS exemption. So I've got it for me, and I got it for my irrevocable trust. And I can do this multiple times. Here's just a wonky thing. A lot of people wonder about this as they say, well, Mike, California is a community property state. I'm married. I have the stock. It's $20 million. Don't I get a QSBS credit, and my wife gets one too? Shouldn't we have 20? Community property, that should be the way that that's interpreted, right? That should be the way the code's interpreted, right? 10, 10, it should be 20. The legal argument to that sounds very good, but the code is written in a way that it really also looks like this is per tax return. So even though under state law and thinking through the logic of ownership and the code, it looks like we should each get 10, 10. I have never found an accountant that was willing to take that position, who was going to actually file the return. All of them were very, very worried about it. Even myself, I said, that's a $10 million, you're exposed for $10 million taxes at 23.8%. That's a lot of tax. 2.3 million in tax. That's a lot of risk. And also, you're going to get penalties on that, and you're going to get interest on that. That's a position I'm not super comfortable with. Well, just do a spousal lifetime access trust. If I say, oh, I don't want to gift to my kids, I want to be able to enjoy this for my wife and I in retirement. I only get one QSBS election. What can we do? How about this? We do a spousal lifetime access trust. I'll give my wife half. I'll keep half. Mine's sold. The slap for my wife, it's a non-grantor trust. It sells. Well, now I doubled it, and I keep it all in our generation. So we can do it that way too. That one's very safe. So a lot of people, if you're husband and wife, they say, I don't want to go down to the next generation yet. No problem. We'll just do the slat. Bada bing, bada boom. We're good. And we can keep it in one generation, and we have far less risk of the IRS interpreting the law, as some legal scholars have really said, in that it's per return also, that there's a per return rule in there. So for this, it can work by essentially adding more holders. So this is the key thing for QSBS is QSBS is great, fantastic avenue, and it can get even better. Don't panic if you say, wow, the money is more than $10 million. My follow-up question is, well, do you have other people you care about? Because if you have other people you care about and you're willing to gift, we can multiply and stack the QSBS exclusions. So that is very valuable.
Okay. I think we can skip next slide, Michael, right? The stacking. I think you
Yeah, we
already
talked about
mentioned that. Yeah, since we have time restraints. So next one, let's look at the gifting versus sell. So what would actually I saw that these questions in the Q&A too. So people ask what is a good timing for QS to set up the QSBS and the timing for gifts versus sell.
Yeah. So this is actually very, very, very critical. Is the first thing is, if you have a company that looks like, or you're involved in a company that looks like it's qualified as QSBS, begin the initial procedures to check qualifications and begin to create the burden of proof file, the burden of proof binder of ticking off these things that, we're a corporation, we're a C corporation, we were capitalized with less than $50 million. The initial issuance of all of the stock was X date. What did the share certificates say? Were the share certificates issued? Are there meeting minutes that show this? A corporation that's well run generally should have these things, but small companies often don't, or it's kind of messy or kind of here and there. We need to clean that up. Why? Because it may save people $2.3 million or more in taxes. So it's worth it. We got to clean this up, get that all situated. Then from there, with knowing about QSBS, we have to worry about this thing called the assignment of income doctrine. And essentially, there is a risk here on this QSBS stacking of when to do the gift. So again, we need to do the 5-year holding period. We need to do this so that we qualify for QSBS. But we have a problem then if, okay, I'm in year 6 and all of a sudden I get approached to do the sale and to have the company be acquired. What I cannot do is essentially negotiate the sale, argue out all the terms, get the LOI, get a term sheet, negotiate the term sheet, and man, we're going to really have a problem. I get into contract and I do all of this and I say, it's a sure thing, it's a lock. It's going to happen. We are going to close December 31st, 2025. And we sign all of that. And it is contractually certain. In fact, if the buyer bails, they're going to owe damages to us. And I'm like, yes, I locked it all up. Now I do all that and I say, great, I locked that all up. I'm going to go talk to Mike about how I can do this QSBS stacking. Well, you're going to see me with a frowny, unhappy face. Why am I going to give you an unhappy face? I'm going to say, wait, so it is a contractual certainty that the sale is going to happen. And he said, yes. In fact, I mathematically calculated it all, and I made it so it was a contractual certainty. And now I know that I need exactly, one QSBS for me, one slap for my wife, and one irrevocable trust. I wanted to be certain because I didn't want to waste any money on legal fees too early. I wanted to be certain. I said, well, you made it certain that you will probably not qualify for QSBS stacking. So what? Why? So because you made it a legal certainty that you're essentially just doing these gifts to double the QS or to stack the QSBS, and because it is now a contractual certainty under the assignment of income doctrine, you're basically just shifting the income to the SLAT and shifting the income to the irrevocable trust, assignment of income doctrine. You look exactly like that scenario. You did the gifting solely for the purpose to shift the income to the lower tax or tax benefited taxpayers. Can't do that. See, can't do that because of the assignment of income doctrine. Where do you need to start talking to the tax planners? Far earlier in the transaction. You want to do it when you say, we are a QSBS company. We are meeting the time requirements. Our exit strategy is going to be sale or acquisition somewhere, but we don't have a buyer. Ideally, we don't have the buyer yet. Or if we do, oftentimes people say, well, that's too early, to get in touch with somebody. Well, we do have the buyer yet, but there's definitely no agreement. Ideally, we don't have the LOI. We don't have any exclusivity. We don't have any contractual. We definitely don't want contractual obligations to follow through with the sale. Earlier is better, because then I'm not strictly assigning income. If I do the gift to the SLAT, and I do the gift to the irrevocable trust, and the IRS says, well, see, that's assignment of income. I say, as of November 5th, no way. How could it have been assignment of income? They say, well, it eventually closed. I said, well, yeah, but I didn't know that on November 5th. I knew we were in the market. I knew we were looking for buyers. I knew ABC Corp was interested, but we didn't have a term sheet. We didn't have an LOI. We didn't have due diligence hadn't started. We hadn't done anything yet. That transaction could have fallen apart. In fact, and I've dealt with some of these, sometimes it does. Sometimes the first bite at the apple does fall apart. I've had some clients where the first bite at the apple, even with the first company, falls apart. And then 3-4 months goes by, and then they do it again, and the second one is successful. The second round of negotiations then works. Perfect. That's not me assigning income and just shifting it over. That you can't do. So in the process of QSBS, there is a process of course, first making sure your company, your shares qualify. Then there's the second process, exploration, to say, if I do the stacking, how am I going to do it? And then pulling the trigger relatively early in the transaction, not necessarily like way in advance, but pulling the trigger early enough so that I don't have assignment of income come back to bite me. That also assignment of income can bite me for estate gift tax too, is in addition to that problem that I assigned income and they won't give me QSBS, under the estate gift tax rules, if I gift it early before there's an acquisition event, the value of the company for estate gift tax purposes is likely much lower. Once we're in contract, it's essentially the value of $10 million, because they say that's how much they're paying. So if that's what they're paying, then that's what's going to happen. So with that, there is a timing strategy here of how do we get it into the QSBS so that we don't assign income and we get a good estate tax, gift tax valuation rate.
I think with the last 9 minutes.
Just one more thing that I want to talk about, I think is the next
Sure.
slide before we round out our last 5 minutes here.
Yes.
Let's see. Yeah, so we already know this.
Yes, the next one. Yes, how to work. I think it's how to work with your CPA, your attorney.
Here's how to work with everybody. I just want to say one other thing about this. So think about QSBS. Let's say this scenario before we part. I hear, okay, I get QSBS for me, my wife, but we're in California, we don't conform. So there's a California tax there. But what about we say, my son's going to UT, he's University of Texas, and he loves it out there, he's gonna stay. What about that? Now we got an angle here. Maybe we have a situation where we should gift some of this stock via a Wyoming or Nevada irrevocable trust, no tax jurisdiction, non-grantor trust. The beneficiary is a non-Californian, and I keep my 10 million for me, and then I have my 10 million for gifting. I gift that into the out-of-state trust for the out-of-state beneficiary. I will have gifted out of the California taxing system. I will have had a bona fide gift that went to a non-grantor trust. Those tax attributes don't flow back to me. It's in a non-tax state like Wyoming or Nevada, etc. And then even the beneficiary, which is really critical, also resides in the non-income tax state. And in that situation, we have the beauty of, I got the asset out, I got QSBS for me, I got QSBS at the federal level for the trust. I'm going to pay California income tax, but the trust won't, because the trust isn't in California. bona fide gift, completed gift to a non-grantor trust, that liquidation event, when those shares go up to the buyer, that will not be taxed in California. It's outside of California. And we will not have a problem of this coming back to bite us, which is really critical, is the beneficiary is also not going to return to California. If the beneficiary was in California, California has, because they don't like this, obviously, we have a throwback tax. If you do this, you have the trust outside of California, you do the liquidation event, and then you start to pay the accumulated gains to California people. We have a throwback tax, which will then basically start taxing backward all of the taxes that got missed. So you have to have the right combination of people and places, but if you do, you can save another potentially 10 to 13% on this. So a lot can be saved. So as you can imagine, we're reaching the top of the hour here. This is a classic one where you really need a team. You need a group of people. And so you're going to have the accounting professionals, often on the company side of, do the shares, does the company look like QSBS? What records do we have to support this? Are we in QSBS standing? And that's to some extent the lawyer, some extent the CPA, but that's more on the company side. What have I got? And what do the records look like? What does my burden of proof binder look like? And same way, CPA, what's my, federal exclusion, what's California, what am I looking at there? And then for the attorney side, we're really thinking about when do we gift? How do we gift? Do we do the non-grantor trust for stacking? Do I do the spousal lifetime access trust? Do I do that or do I not? How safe are we? How are we going to value the gift? When are we going to do it? That's part of the strategy here. So this is one, because there's going to be multiple people working on this, and it is always far better work on this early. I have had a number of situations, just because it's the way life goes, where the client approaches us at the contract phase. And they say, I want to do the QSBS stacking because the deal's real and I have numbers on it. And I've looked at the numbers and the tax numbers are bad. So I want to do the QSBS stacking. And that's always a tough chat, because we say, you came to us very, very late. And because you came to us very, very late, this transaction is very high risk for gift taxing, because the valuation of the company is going to be high. And this is very high risk for QSBS because you have assignment of income risk. If you did this earlier in the cycle, this would have been a lot easier, in that we could have gifted those shares at probably a much lower value, and we would not have the risk as great for assignment of income. Being late on this and saying, well, I'll do it right before the transaction closes, or right at the transaction sort of consummation part, that's going to be a problem. So this is something that you really want to, when the puzzle pieces start to come together, start getting professional guidance early, because the timing is important on this.
Great. Okay, I think we still have like 3 more minutes. Let's just answer a couple more questions. And if you don't have any questions, feel free to leave. I know at lunchtime, everyone is busy. If you have any individual questions, feel free to reach out to us via our phone number or email address. Okay, let's answer probably 2 or 3 more questions. This one is, I think a lot of audience, they still have the questions as to what kind of business can be qualified for QSBS. And this person asked if a daycare center can be qualified, or in general, if a service industry qualifies.
We'd have to look at it. The label, not all services revenue, kills the QSBS. So there are some things like software as service, payment providers, things like that.
Yes, someone does ask for a fintech company, a fintech startup.
And like that, that's really one that we would have to go and look through the business, because some fintech, if it's actually like the services software or the payments provider, or you're creating infrastructure, or developing your processes, or your blockchain development technologies, that's probably going to be okay. But if you have something that is like a lending business, a brokerage business, an investment advisory business, that's not going to be okay. And so this is one that you need to look at the specifics. And if you're a borderline one, you'd want to begin early. You're working, with attorneys and advisors to make the business lean towards, the qualifying side, and say, okay, let's do the line of business and do the activities more towards the qualifying side than the non-qualifying side.
Okay, and this question is, when do founders investors need to set up the QSBS for the shares?
Yes. So the good thing is, essentially, there isn't a need to like set up something for QSBS. It's good, and that you don't have to like create something. What you have to do is qualify. So basically, it's understanding for my company shares and the company that I'm operating. Am I qualifying? C corp. Correct industry. Da 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 da. Am I qualifying? And so it isn't necessarily something that I have to file something or I have to do something, but it is important to understand what the rules are, and then essentially apply it to my particular company, my particular business, and then realize, like, okay, as long as I do this and I have my ducks in a row, and I keep going that way, I'll be okay. Then you'll be okay. Basically, what you're trying to create is that burden of proof file, so that you say, okay, I have all of the records that I was original issue. Company was the assets, at the time that it was created was less than $50 million. So it's not that the valuation of the company has to be less than $50 million at the time it's sold. It's at the beginning, was it capitalized in an amount of $50 million or less. Most people can that's not a big qualification problem, unless the company really was bringing in very significant initial capital. Most of the time you're okay there.
Great. Okay, it's 1 o'clock and we have to end our webinar today. Thanks again for everyone for joining us. We hope we can see you next time.
Take care, all.